I'm not too sure what you mean by is the worst over for India, but currently we have India's ratings on a stable outlook, which we revised back in June. And we think this really fairly reflects the outlook for India's sovereign ratings. We understand that India's economy is going through a difficult transition period, given recent pressures on the currency, which has spilled over onto the economy and onto inflation. But at the same time, we do recognize that there has been some developments in terms of improvement in the current account, and there seems to be a change in the RBI's focus on inflation, which is a positive development. Yeah, it's difficult to say. We're currently forecasting 4.8% of GDP versus 4.8% for GDP growth this year versus 5% next year. So I think the way to interpret the GDP data is that it's suggesting that the economy remains quite weak, and looking ahead into fiscal year 14-15, that the economy's recovery is likely to be quite weak, where we're expecting growth to still be in the 5.5% to 6% range. So overall, the prospects for a sharp economic recovery still remain quite low. Yeah, assessing both the foreign exchange and interest rate outlook is quite difficult given recent events that have taken place over the summer, where there's been a lot of pressure on EM, or emerging market currencies, because of concerns over Fed tapering. And given that Fed tapering has yet to happen and is likely will happen inevitably or eventually, that this makes the outlook for both the FX and interest rates difficult to assess in India. But I think, the rupee is likely to remain range bound at the current levels, and similarly, interest rates also. The RBI has indicated that they're going to be more focused on headline retail inflation going forward, which means that the policy rate, which the RBI actually increased in its last monetary decision, may actually increase a little further.